Hello everyone, this is Michael Carroll for the Business 201 Exam 2 review. And so we'll jump right into it. So first we're going to be looking at the different types of inventory methods, FIFO, LIFO, and average inventory. Here we've got a schedule of what happened. We began with some inventory, we made some purchases, and then we sold some inventory. So in the following questions, we're going to be trying to calculate the cost of goods sold using FIFO, LIFO, or average. To begin, we should just go over the equation. Beginning inventory plus our purchases minus ending inventory gives us cost of goods sold. So that equation we'll be using pretty much this whole time in Chapter 6. So if we look at the facts, we're going to be going over FIFO periodic first. A periodic inventory system updates the inventory at the end of the period. So in other words, we don't care about when we sell the inventory. We're just going to wait for that at the end of at the end of the period. So we began with 1,000 units at $1 each. We purchased 2,000 at $2 each, purchased another 2,500 at $3 each, and then we purchased 3,000 at $4 each. Now we can multiply those across. We've got $1,000 in inventory there, 4,000 there, 7,500 there, and then 12,000 right there. If we add that up, we should get, let's see, 24,500. Now that number represents the cost of goods available for sale. The cost of goods available for sale is the beginning inventory plus purchases. That's pretty much what we just did. The cost of goods that we have available for sale. Now we sold 4,000 units and 2,700 units. 4,000 units were sold, 2,700 units were also sold, for a grand total of 6,700 units sold. Using FIFO, we're gonna sell the first inventory that we had. So I'm gonna sell 6,700 units. This first 1,000 I'm gonna sell. The next 2,000 I'm gonna sell. I'm going to keep selling until I sell all 6,700. So I'm going to be left with 1,800 units in this last category. So 1,800 units at $4 each. 1,800 at $4 each gives us $7,200. There's our ending inventory, $7,200. So we can plug that into the equation. Beginning inventory plus purchases minus ending gives us cost of goods sold. Our ending inventory is $7,200. We're going to subtract that from our cost of goods available for sale, which is $24,500. Here's the cost of goods available for sale, $24,500. Minus 7,200 is our cost of goods sold, 17,300. So there's FIFO periodic. FIFO perpetual is fairly similar, but we're gonna update our inventories after perpetually. So every time we do something, we're gonna update our inventory. We began with 1,000 units at $1. We then purchased 2,000 units at $2. We then purchased 2,500 units at $3. And then we sold 4,000 units. So I'm going to take 1,000 out of there, 2,000 out of there, and then 1,000 out of there, leaving me with 1,500 right there. Then we keep going on. We purchased 3,000 units at $4 each. And then we sold 2,700 units. So I'm going to take the full 15 out of there I'm going to take the remainder out of there, leaving me with 1,800 units at $4 each. And so you should recognize that that is the same thing as what we just did before. 1,800 times 4 is 7,200. That's my ending inventory. Again, we take our beginning purchases, our beginning plus our purchases minus our ending to get the same cost of goods sold. So our cost of goods sold for periodic and our cost of goods sold for FIFO perpetual are going to be the exact same. Okay, moving on to LIFO. LIFO periodic. Again, if it's periodic, we're going to update the inventory at the end of the period. So we can just write down all of our information, ignore the sales. We began with 100 at 1, 200 at 2, 250 at 3, and then 300 at 4. With LIFO, we sell the last inventory. So we're going to go from the bottom up. So if I sold 6,700 units, I'm just going to keep crossing off until I cross off 6,700 units. So I'm going to be left with 800 priced at 2, or costing at 2, and then 1,000 cost of 1. So if I multiply across, 1,000 times 1 is 1,000, 800 times 2 is 1,600, leaving me with $2,600 in ending inventory. So that's my ending inventory. I'm going to plug that back in to the equation to figure out our cost of goods sold. So our cost of goods available for sale is $24,500 minus our ending inventory of $2,600, giving us a cost of goods sold of $21,900. There's our cost of goods sold for LIFO periodic. You should also recognize that the number of units that we end with is always going to be 1,800. 1,000 plus 800, 1,800 units. Now don't use this number in our equation because we need a dollar value for our inventory in this equation. We don't want the number of units in this equation. So always figure out the dollar amount. Okay, and then we can go to LIFO perpetual. So again, with a perpetual inventory system, we constantly update our inventory. So I'm going to go in order. Start with 1,000 at $1. Then we purchase 2,000 at 2, 250 at 3, and then we sell 4,000 units. When we sell 4,000 units using LIFO, we're going to take from the last inventory we just received. So I'm going to take 2,500 out of there, and then I'm going to take 1,500 out of there, leaving me with 500 units. Continue on, we purchased 3,000 more units at $4, and then we sold 2,700 units. So again, I'm going to take from the last inventory, I'm going to take 27 out of there. I'm left with 300. So that's all that happened, so we can multiply across now. 1,000 times 1 is 1,000, 500 times 2 is 1,000, 300 times 4 is 1,200. And it's a grand total for 3,200 as my ending inventory. Again, go back to the equation. Take 24,500. That's my cost of goods available for sale, minus my ending inventory of 3,200. Gives us a cost of goods sold of 21,300. That's FIFO perpetual. Okay, and again, we're still left with 1,800 units, 1,000 up here, 500 here, 300 here is 1,800. Again, don't use it in that equation. Okay, and now we can move on to average periodic. When we're doing average inventory methods, we always have to figure out the average unit cost. Hopefully that will become clear once we do it. So we'll start with average periodic. Again, periodic we update at the very end. So we record, as we've been doing, all the beginning inventory and the purchases. So 100 at 1, 200 at 2, 250 at 3, 3,000 at 4. And now I need to figure out the average unit cost. Here's the unit costs for these individual inventories. So these 1,000 units have a unit cost of $1. These 2,000 units have a unit cost of 2, and so on. Now, to figure out the average unit cost, you can't just add these up and divide by 4. We need a weighted average. The way to do that is, let's first multiply across for all of these. And then we're going to add up these two columns. So how many units do we have? We've got 8,500 units. And we've got $24,500 in inventory. To find the average cost, we take 24,500 divided by 8,500 to get $2.88. There's our average unit cost, 2.88. So every unit on average costs us $2.88. Then we'll go back to the facts. We sold 4,000 units. We also sold 2,700 units. So in total we sold 6,700 units. We're going to take that out of inventory. And we're left with 1,800 units, as we've always been doing. The 6,700 units that we sold, each one of them has an average cost of 2.88. So that means we took $19,312 out of inventory. So we're left with $5,188 in inventory. So you can subtract it to find that number, or you can take 1,800 times 2.88 to get that number as well. So here's our ending inventory. Here's our cost of goods sold. The question is asking for what is the gross profit if the selling price per unit is assumed to be $10. So we sold a bunch of inventory, and that inventory cost us $19,000. We're selling them at $10 each. So let's think about a income statement. I'm going to draw it right here. We're going to have our net sales. If we sold 6,700 units at $10, 6,700 times $10 is $67,000. So we had $67,000 in sales. And again, I got that $10 from the facts. We're selling them at $10 each. We sold 6,700, $67,000. Our cost of goods sold is $19,000. And 312. We subtract that from our net sales to get a gross profit of $47,688. There's our answer. And then, okay, so the next page, let's see, we're Doing some multiple choice, so number 4, we've got, or a manufacturer discloses inventory on the balance sheet as, and we've got a bunch of answers. So the answer is C. We have finished goods inventory, raw materials, and work in process. You can think of, a good example is like a car manufacturer. We have raw materials. They might have just sheets of metal lying around, or like tires lying around, or doors lying around, whatever. They'll have work in process inventory, which are half-finished cars or not quite finished cars. And then we have finished goods. We have, or they'll have fully assembled, ready-to-go cars. So those are the 3 different types of inventory: raw materials, work in process, finished goods. If the beginning inventory is understated in the financial records, cost of goods sold will be overstated. True or false? That is false, and the reason is, the best way to think of it is looking at our equation. We've got beginning inventory plus purchases minus ending equals cost of goods sold. If the beginning inventory is understated, it's a down arrow. If it's understated in the financial records, our cost of goods sold will be overstated. So if our beginning inventory is small, our cost of goods sold will also be small. So this is false. The cost of goods sold will be understated, not overstated. All right, number 6, if a company understated beginning inventory or ending inventory, so if we go back to the equation, cost of goods sold, if our ending inventory is understated in the financial records, income taxes for the year will be overstated, understated, or not affected. It will be understated. Our income taxes will be understated, and here's why. So if our ending inventory is understated, or in other words, our ending inventory is small, our cost of goods sold will be large, right? Because if we're subtracting a smaller number, we're going to get a higher answer. So our cost of goods sold is going to be overstated. From there, we have net sales minus cost of goods sold. Gives us our gross profit. If our cost of goods sold is overstated, or it's really big, our gross profit is going to be small. If we subtract a really big number, we're going to get a small answer. If our gross profit, and let me switch over, if our gross profit is small, and on the income statement we go from our gross profit and then we subtract all our expenses. If our gross profit is small, our income before taxes is also going to be small. If our income before taxes is small, when we multiply our income before taxes by our tax rate, our taxes is also going to be small. So if our ending inventory is understated, our taxes will also be understated. Okay, so that's the multiple choice. Now we go to Chapter 7, the bank reconciliation. So unfortunately, when I made this, I guess I was really tired and I didn't write like all the information that you needed. So hopefully you can see it here. We've got a deposit in transit for $5,000, an electronic funds transfer for $3,000, a non-sufficient funds check for $2,000, a bank fee for $100, and then this little fact: we've paid off what we owed for inventory. We paid $2,500, but incorrectly recorded $5,200 in our books. So we'll get to that later. So we're going to fill out this bank reconciliation. I already filled it out, so I'll just kind of write down the stuff over here. So let's first look at these checks that we wrote. We are trying to determine which checks are still outstanding, and an outstanding check is a check that we paid someone. So think about, like, you give a check to your niece or nephew for Christmas, but they haven't deposited the check yet. You know you paid them money, but your bank doesn't know that you paid them money. So, since one person knows and the bank doesn't know, there needs to be some reconciliation. With these outstanding checks, we're going to figure out which checks do the bank know and which banks do they not know. So right here we've got checks that are outstanding from last month, from the month of October. Check 107, the bank didn't know about check 107, nor did they know about check 108. Now in November, the bank shows that they have seen check 107. So check 107 is no longer outstanding. They have not seen check 108 yet, so check 108 is outstanding still. They've seen check 109, so that's not outstanding, and they've seen check 111. They have not seen check 110. So 108 and 110 are outstanding. We'll take the total 5550 plus 8,800, and that gives us a total of 14,350. And hopefully you can see that right here. We're going to subtract our outstanding checks for 14,350. The reason why we're subtracting it is because we've paid this money out, but the bank hasn't seen that we've paid this money. So we've got to subtract that money from what the bank thinks we have. Oh, and I didn't mention what our beginning cash amounts were. So, according to our books, we have $84,010. According to our books. According to the bank, we've got $96,960. So on our bank reconciliation, here's our cash balance per the bank, $96,960. We're going to subtract our outstanding checks for $14,350. And then we can move on to this deposit in transit. A deposit in transit is, we've deposited this $5,000, but it's still in transit. The bank has not seen it yet. Since the bank has not seen the deposit, we're going to add that $5,000 to what they've stated that we have. And that's all the things that that affects the bank side. So we'll take $96,960 plus our deposit in transit minus our outstanding checks to give us an adjusted cash balance per the bank of $87,610. Okay, now we can do the book side of the reconciliation. We'll start with this EFT, an electronic funds transfer. This happens when a customer directly deposits a check or some kind of payment into our bank. We did not see the payment, it went straight to the bank. Since we did not see it, we've got to adjust our side of the reconciliation. So we're going to add the EFT for $3,000. $3,000. And we're adding, obviously, because we have not seen that money deposited yet, so we have to show that we got that $3,000. And again, here's our beginning balance per the books, $84,010. So we'll add that $3,000. Next, we can go on to this non-sufficient funds check. An NSF check is a bounced check. Someone gave you a check for $2,000. You recorded that you received cash, but then the bank tells you that that check is no good. The customer, whoever gave you that check, does not have the money to pay for the payment. So we're going to subtract the bounce check from our book because we did not receive that cash. The check was no good. Then we got a bank fee of $100. That's pretty self-explanatory. The bank charged us $100, so we're going to take that out of our cash. And then this this error. So we paid off some inventory we owed. So this sounds like we bought some inventory like a month ago or so. We owed them $2,500 for the inventory. We paid them, we gave them cash or whatever, we gave them the money for $2,500, but our accountant incorrectly recorded $5,200 in our books. So he mistakenly flipped the numbers. So when our accountant incorrectly recorded this $5,200, he probably did something like this. He recorded a debit to accounts payable for $5,200 and a credit to cash for $5,200. We're paying off our liability and we're paying it with cash. Now, it should have been $2,500 for these amounts. So instead of just scratching this off and writing $2,500, we're going to make another journal entry to adjust or correct this problem. So this number should have been $2,500, or we need to decrease the amount we're debiting to accounts payable. In order to do that, we're going to credit accounts payable for the difference, $5,200 minus the correct number, $2,500. And that gives us $2,700. And then the same logic, we recorded too much leaving cash, so we've got to decrease the amount of cash we credit, so we're going to debit cash by $2,700. Here's what's happening. So we're going to increase cash by $2,700. And that's what we do here. So here's our error that the accountant made. We're going to increase cash by $2,700 because he recorded too much leaving. So start with 84,010, add the 3,000, add the 2,700, subtract 2,000, subtract 100, and you'll get 87,610. The same numbers, which is good. So there's our reconciliation. We can also do some journal entries for these. We only journalize the the adjustments for the book. We never do we never journalize anything for the bank. So we'll start with that electronic funds transfer. For the electronic funds transfer, we're adding $3,000 in cash, so that's simply debiting cash for $3,000 since we're increasing cash. And we're going to credit something for $3,000. The electronic funds transfer was most likely from a customer paying off something that they owed us. So it sounds like they're paying off an accounts receivable. The error, we already did that. So here's the journal entry for the error. We're going to debit cash for $2,700. We're going to credit accounts payable for $27. So we already did the journal entry for that. The bounce check for $2,000. We're subtracting cash, or we're going to credit cash for $2,000. And the bounce check, this is probably from a customer paying off something that they owed. So we're going to debit accounts receivable for $2,000. You can think of it, when they gave us the check, we probably said, okay, they gave us cash for $2,000, and we're going to decrease their accounts receivable by $2,000. Now we find out that the check was no good, so we're just going to literally reverse this entry. Debit accounts receivable, credit cash. So here's a journal entry for the bounce check. And then the bank fee, we're decreasing cash by $100. And we're going to record some kind of bank fee expense as a debit for $100. There's the journal entries. Okay, moving on to Chapter 8, reporting and analyzing receivables. So, this question is pretty long, but at the very end it's asking us what is the balance in accounts receivable at the end of the year. So, I'm going to set up an accounts receivable T account, like so. And then we'll go through. So at the start, we've got an allowance for doubtful accounts as a 5,000 credit balance. And our accounts receivable started the year off with 70,000 debit balance. So 70,000 people, people owe us $70,000 as of now. During the year, the company made 100,000 credit sales. So when we make a sale, you can think of this, well, when we make a sale, a credit sale, we're increasing our accounts receivable by 100,000. You can also think of the journal entry. When we make a sale, here's the journal entry, debit accounts receivable, credit sales revenue for 100,000. So we're going to debit accounts receivable by 100,000. We've made $8,000 in write-offs. So we said, okay, we're never going to collect this $8,000. So we're going to take that out of our accounts receivable. You can also, here's the journal entry. When we write off our receivables, we debit allowance for doubtful accounts for $8,000, and we credit accounts receivable by $8,000. And that's exactly what we did. We credit accounts receivable by $8,000. Okay, and then we've got 90,000 receivables have been collected at the end of the year, or by the end of the year. So if we collected accounts receivable, we're decreasing accounts receivable by 90,000. And here's a journal entry for that. So we're going to be collecting cash for 90,000, and we're decreasing our accounts receivable by 90,000. A customer called us during the year and paid $1,000 of receivable that was originally written off. So when we made this journal entry to write off $8,000, we thought we would never collect this $8,000. Now a customer is calling us up and said, hey, I have $1,000 I can pay you for that we originally thought we were never going to get. So when we have a reversal like that, we're going to reverse this original entry. So we debit accounts receivable for the $1,000. Debit accounts receivable by $1,000, credit allowance for doubtful accounts by $1,000. So we're literally just reversing what we did. Then they paid us